Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm going to go over real estate in this clip. There's a comment in the background. I'll let you know kind of what's going on. Compare it to the real estate cycle. Get you guys up to speed on what the real estate cycle is. So let's just dive in. Why not? The question is, hey Andy, can you update on housing? I did put my update in June. This is for May. I'll go over the data in this clip too. It says, I watched a video by Meet Kevin. That's a problem. And he showed the data that says house listings increasing massively and with reductions. Your thoughts? Yeah, that's what happens when interest rates go up and the housing market starts to cool, the growth rate. But we can go up many-fold increase or lots of percent gains increase, but at slower rates of increase. So let me get into data. I'll show you what I mean by this. And it's nothing to really worry about because the market's going to behave this way no matter what. We still have a market imbalance, and interest rates does not solve that imbalance. It just makes things less affordable. So I'll get into some of the data, and I'll get into the real estate cycle here. So this is the real estate cycle. What happens is, in this recovery phase on the bottom here, it's a low inflationary, low interest rate environment. And the market is pretty balanced. It favors the buyers in this general vicinity here. It's a buyer's market. When the inventory runs out and the foreclosures run out and everything runs out, we get into this long-term occupancy average where the housing starts start to move higher. And what happens is you go above the long-term average into what's called an expansion phase. Now, at this diamond right here, and somewhere around this general vicinity, that is where the market becomes an ultra seller's market. Because what happens is your inventories run out. They run completely out, and then everyone's bidding for existing homes in the market. The market is short homes. That's what a deficit, supply-demand deficit. And you have the largest amount of buyers in relationship to the number of sellers. That's where this diamond-ish area and just above it is. So that's where the market takes off. That's where you see the largest increase in home prices at any point in the time of this boom. You see it right after the diamond all the way up till about maybe 3/4 of the way up in an expansionary phase. What it's doing is it's turning on the home builders. It's turning on the home builders, and the home builders have to build more homes to meet the imbalance in the market. What's the problem is the number of homes in the system is the problem. So if that is the case, what you look for is you look at rent prices and you look at home prices. Now, I don't know exactly where we are in this cycle. We could be right where the diamond's at. We could be just above it. It's hard to say exactly. But it doesn't necessarily matter. You don't need to know exactly where it's at. What you need to know is you need to know the inventory of homes, the absolute value, and you need to know what the rental prices and the rental rates are doing. Because if the rent prices are skyrocketing higher, it's still going to put pain on people to make decisions to buy homes that are more expensive. So rent prices is the supply-demand of rental availability. If you truly have a number of homes that are short in the market for rent and for purchase, irrespective of how many homes there are per capita, because it's only available homes for sale versus available rentals to be rented. If those are going up, interest rates can go up, but it may not necessarily affect the home price as much as what most people think. Affordability in this type of range, in this area, is the least affordable because you have the most amount of buyers for the least amount of homes. That is, by definition, a squeeze. A squeeze puts prices into the least affordable. Now, home prices just don't fall down. They're very sticky. So what can happen, and what does happen, is people start to list their homes on the market. They list their house on the market. And they just take a guess on what it would potentially be based off of comps, or they do their comparisons against other homes that are roughly the same size, roughly the same whatever, and then they take a guess and throw the house out on the market and see if it sells. If it's too low, they'll get multiple offers, which could be a strategy. And then they'll price it low, get a bunch of interest, and get a bunch of people into a bidding war against it. That is one strategy. Some people try to price it higher. Sometimes it stays on the market longer. And then they'll have to reduce the price if they can't find a buyer. The reduction doesn't mean that the price went down. It's a reduction from where the price was set originally. That's the swag that they put out there. So if you reduce the price by 10 or 20,000 off of a swag that you kind of just went, yeah, it's about here, I'll throw it out there. It doesn't mean that the house actually sold for less than it was last year. It's just saying it sold less than what they lowered the asking price by some amount of a swag that they threw out there already. So the price reductions is just showing you that their swags are off. It doesn't mean that the price necessarily went down. So that's kind of a moot point. Yes, it does mean that perhaps we don't have as many buyers as there are sellers. It's really difficult to say. I have seen some price reductions in homes, especially those that are expensive. I've seen more on the expensive side than kind of the meat of it, where everybody can buy homes. At least here, the meat of it's in the $400,000, $500,000, $600,000, $700,000 range. You get above like $800,000 or $900,000, and that's more expensive in our area. And you start to see more price reductions off of the swags that they've kind of thrown out there. Now, if we were to look at the data, here's the data that I yanked from Realtor.com. This is your weekly data in the United States across the entire nation. I'll zoom in a little bit more so you guys, it's a little bit easier to see here. Okay, so in the yellow are the two that I want to focus on. This is the weekly data. I'm going to go back all the way till 2017. So that's the data that it went down. This is the active listing count in column D. This is your median listing price, and that's really what I'm going to look at. You can also look at the median days on the market, which is this one on the right. That just means that it's moving faster and faster. This is your inventory declining, and this is your home price is increasing. What I'm going to show you is the trend. The trend was in place all the way since 2012. These people who think that the medical event caused this are completely wrong. It's almost like insulting to hear it, because they obviously didn't look at the data. Here's the data, all right? Look at the active listing counts. They are declining. The median listing price is going up, and your days on the market are at like 7. They're going down by 7 days. Now, if you keep going upward, they keep going down in the days on the market. Remember, this is 6 days faster than the year before. So we are continuing to draw down. The median listing price is continuing to be robust, and your active listing count is continuing to go down. And we're continuing all of these in 2018. The trend is all in place. 2019, the trend's in place. And here, if you notice, your active listing counts were going up a little bit. They're going up 4%, 5%, 7% here in 2019. We are still in a huge bull market in this time frame. This was also a time where interest rates were going up a teeny bit as well. And then we went back in 2019. It got hot again. And remember, this also is seasonal. So seasonal, if you look at the seasonality of it, some parts of the previous years, we lost a little bit of seasonality just because the market was getting hot. Other parts, it still had that seasonality in it. Usually, you get some sort of seasonality where the inventory increases through some part of the year. That's usually late summer, fall, where you start to increase your inventory, and it goes on up. And then you get another drawback down, usually in like the springtime. So the springtime, it draws back down, and the prices continue to go higher. The active listing counts go higher, and then you can see your days on the market were fluctuating in this time frame. They were basically flat in 2019. Then you could still see it picked up later 2019. It was actually increasing in your active listing counts, really started to decline in 2020. The trend was in place. The C19 event was, I would say, not a huge factor. It was already in place, all this motion. Then we went into 2020. They did a bunch of money printing. I'm sure that had some impact to some extent. You did see your active listing counts really drop down. Maybe that's because people didn't want to show their homes. You saw median price listing increase. You saw days on the market really come down. And we saw that gigantic move in those listings continuing. Now, if we were to go all the way till recently, we've got in May here, we still have very large increases in the median listing price. They are actually accelerating to the upside still. They're accelerating, not decelerating. And we'll have to see next in June what that prints. But the active listing count did go up by 11.2% in May 28th of 2022. And he may be looking at it, the active listing count, maybe week to week. I'm looking at it year over year because that's what matters. So it was up 11.2%. 11.2% from an incredibly low inventory number is really doesn't mean anything. Also, we've got days on the market that continues to get shorter and shorter. So in all honesty, guys, we need so much more inventory. It's going to take years to bring this back into balance. I just don't see their argument necessarily. Is the market cooling off? Maybe. Maybe not. Maybe the market needs time to adjust to these new interest rates. We don't have a lot of homes. And a lot of people are dropping out of the market saying, I don't want to compete in this because it's too tight of a market. Of course, you'd see mortgage applications go down if you don't have the homes to buy. And no one's going to be refinancing in this, or I would say a lot less people are going to refinance under higher interest rates. That kind of makes sense. Mortgage applications should fall. Now, all you have to do is just look at inventory. Look at what I'm looking at. Don't make any sort of conclusions. Don't worry about it. Just look at the price, inventory, and days on the market that I have here. Everything else, flush it. Flush it on out. Oh, these people, they don't have enough income. They don't have, guys, it doesn't matter. The income, they have enough income. They have enough, they don't have enough homes. How do I know that? Well, price is going up, inventory is remaining low, and the days on the market continue to get faster. That's all going to have to reverse. Now, even if that reverses, even if that were to reverse, prices are still going to go up. Why? Because we're at super low inventory levels. We are still going to go up, just not at as fast of rates. So we're going to have to find out where the breaking point is. I don't know where that breaking point is. That's why I watch this data. A lot of people like to draw to conclusions. I don't like drawing to conclusions. You don't need to. This stuff moves so slow, it does not matter. The trend is in place, and I would not bet against this trend. I think maybe it'll end at earliest 2024, at latest 2030. That's my guess. The trend's in place. You're going to try moving the Titanic. It's probably not going to go back down for a while. That's my take on it. House prices are super sticky. The money's still flowing into this system. It takes 2 years for that money to work its way through inflation-wise. So even if this slows down, you'll still have inflation for a couple more years. These guys don't know that. Kevin won't know any of this. He doesn't know that. He's not going to know this. He doesn't. He hasn't looked at that information. He hasn't digested all that, I don't think. A lot of these other guys haven't either. I'm not saying that I know all this, but from what I've gathered in history and what I've looked at the data, when you look at this data and whatnot, these things don't move fast. You just have to look at the last. You have to look at the last housing market bubble, and they were literally giving loans out to anyone. I don't think we're anything like that. That's my opinion. And everyone's so worried about people not affording stuff. Well, I'll just say this: if they can't afford it, how did we get in this situation to begin with? Answer that question. It's not because of money printing. That obviously may boost some of this, because if you increase interest rates even faster, people aren't going to keep their money in bonds. They might go buy some real estate. Why not? Lock in a low interest rate in a real negative interest rate environment and pay it back with worthless dollars. Perfect. Maybe that is fueling a little bit of the bubble. And this will end in a bubble. It will end in a bubble. We're just not there yet. That's my opinion. It will end in one, but we're not there yet. And I'll say this, I'll retract. We may end in a bubble, we may not. It depends on what the home builders do and how fast they build homes and what the imbalance will be at the end of it. I can't make that claim because right now we are so far out of balance to even talk about a bubble is like moot. We don't have any inventory. If you don't have inventory, you can't be in a bubble. That's my take on it. But at some point, it could be a bubble, and we'll see it through the inventory numbers. Right now, no matter what this percent gain is, this is going to have to go up hundreds of percents, hundreds, maybe even thousands of percents over year if you're coming from a very low level. So if you had to go 10x on the inventory, you go from 1 month in some of these cities to 10 months. That's let's say a 9x. That a 9x is, what is that, 800%? So we have to go up 800%. Is 11.2% a lot versus 800%? No, it's not. So that's where we have to go. We're not there yet, and it's going to take a long time, and we don't know if that inventory is going to go back down. We'll have to watch. And I'll come out with June's numbers in July, early July, when they release the numbers, and I'll do another update. Again, guys, this is going to take years. Don't get worried. Just sit tight. If you guys like the analysis, give me a thumbs up, subscribe to the channel, subscribe to the website, the Platinum membership. That's where I'd be. And, you know, I share data like this all the time. So that's what I've got. We'll catch you next time. This is Finding Value.